Welcome to the special panel on cryptocurrencies, blockchains, and the future of financial services. Let me just tell you a little bit about the background of the session. I actually, as program chair, created categories, buckets, for papers to be submitted to the AFA program. And we had 2,000 papers submitted. And one of those buckets was the topic, cryptocurrencies, blockchains, and the future of financial services. The number of papers we got, 0. So not a single paper. But nevertheless, the discretion of the program chair, I thought it would be a good idea to engage Dave Yermack to create this panel. In my opinion, this is very important stuff. For the last couple of years, I've taught a course at Duke University on blockchain, and I think it's a situation where potentially the practice of finance is a bit ahead of academic finance. And I think that we need to resolve that situation, and this is a step in that direction. So I'll introduce the chairman of the session, David Yermack.
Thank you, Cam. Thank you all for coming this morning. I think that, in fact, it's almost always true that professors are the last to find out about innovations in the real world. But this one can, I think, hardly be missed given the amount of media coverage and the number of large, well-known organizations that have made commitments to it just in the last 6 months. So we have 3 people from industry from very different roles who are going to be on the panel today. And let me begin by introducing them. To my immediate right is McKenney. She is from Citigroup. She's the head of cross-border payments, basically dealing with transfers of foreign exchange between institutional parties. She operates out of the London office. Further to the right is Michael Casey. Michael is a senior advisor to the MIT Media Lab, which has a digital currency initiative. So he represents the academic work that's beginning to take place in this area. Michael was a reporter for many years with the Wall Street Journal, and earlier this year resigned to cross over to academia to essentially invest his human capital in this technology. And on the far right is Tim Swanson. Tim is the Director of Market Research for R3. This is an organization which is a consortium of many of the leading banks in the world. I think it's 42 banks at the present who have joined up. And they're working together to create an internal system for clearing and transfers of various financial assets. So I think we have 3 speakers who have very different perspectives on the industry, and I've asked each of them to begin with about a 10-minute introduction to discuss their organizations, what they see as the emerging issues. And we are hoping to have a lot of discussion and especially audience Q&A as the panel unfolds. And I hope that at the end of 90 minutes, people see not only a lot of research and teaching opportunities, but really an impression of how the technology behind a lot of this can change the financial system quite profoundly, I think, over the next 5 to 10 years. So Tim has brought a presentation, so I'd like him to go first.
Yeah, the clicker doesn't work right now.
Oh, sorry.
That's okay. Hey guys, good morning. Thanks for coming. I'd like to thank David and Campbell again for inviting us. So again, my name's Tim. I'm Director of Market Research. So I spend a lot of my time talking to startups and to banks and then putting together reports. Maybe you've read a couple of them. They're out there in the public domain now. So today's topic is fairly broad. I believe all 3 of us have a different perspective, which is going to be pretty cool. So I'm just going to dive right in. Real quick, raise your hand. Who's ever heard of the term blockchain before? Okay, great. Out of curiosity, raise your hand if you have a background in finance. Okay, economics, both. All right, great. So this will be a fun panel then. So yeah, this chart here is from Google Trends. It basically shows the last 3 years of the term. If you just look up blockchain, what that is, I would argue that it's jumped the shark at this point. If you looked at Sibos back in October, anyone and everyone was talking about blockchain this and blockchain that. I really think it's kind of like gluten though. Like, you know, a couple years ago, everyone didn't like gluten, but they couldn't tell you what it is. And I think that's kind of what blockchains are. Everyone thinks they're cool and they're great, but no one can really tell you what they are. So hopefully after, you know, the next 90 minutes, you'll have a better idea. So for academics in this room, which I believe is all of you, if you're looking for research, just a way of kind of making a split into how you can do this. If you have a background in finance, you may be more interested in the non-cryptocurrency side of things, basically the financial infrastructure. So things like how can you replace or how can you modify the middle and back office with some of this tech? How can you change, for example, the traditional reconciliation process between different accounts, between different banks? And how can this impact clearing and settling of, for example, OTC derivatives? Now, this is not to say that before this tech existed, you couldn't speed up processes or you couldn't change or enhance or make things efficient. The whole fintech movement obviously is pretty frothy at the moment, but that's a whole other conversation, another panel. So for the economists in the room, the virtual currency side of things, again, R3 is not a virtual currency company. I could discuss that in a little bit. But if you're interested, there's a whole field of the cryptocurrency side of things with Bitcoin and Ethereum that really hasn't been looked at from a real professional standpoint in terms of like what are the long-term sustainability of these different networks. We've had 100 different altcoins that have died in the last 2 years because there's not a whole lot of incentive to keep these networks running, and there's not a whole lot of study on why this necessarily is. You have a series of collective action problems when it comes to governance. Because these are public goods, there's not a whole lot of easy decision making in the sense that if you wanted to enhance the networks to improve them or to add new features, trying to coordinate that in a decentralized way is very difficult. And then there's also the preponderance of users just wanting to basically hoard the currency itself. That's obviously not going to win me a whole lot of friends in the community, but as the economists here, you guys study what makes a currency a good medium of exchange. Some trade-offs. So has anyone ever heard of a guy named Satoshi Nakamoto? Is anyone here Satoshi Nakamoto? That's disappointing. Okay, so yeah, there's this guy who supposedly created Bitcoin. His name is Satoshi, and if he had wanted to design something for banks or for financial institutions, whatever he would create would probably look a lot different than what Bitcoin does today. And I say that not to say something bad about Bitcoin, but it has trade-offs when you're building these systems. And so one of the assumptions when you're building a cryptocurrency system is, at least the current cryptocurrency systems, is you don't know and you don't trust participants on the network. Well, if you are working with financial institutions that are regulated, you do know and you do have to trust these institutions from a legal perspective. So it changes the trade-offs in when you design these systems. And one of the trade-offs comes from this. With Bitcoin and Ethereum and a few of these other cryptocurrencies, they're basically censorship resistant, meaning it's very difficult to shut down. But the trade-off to that is you end up having probabilistic settlement. And so what that means is given enough capital, you could actually reverse blocks. You could actually reverse the transactions from taking place, reverse history. And that may not be a big deal for those in the cryptocurrency world, but is a big deal for those in the financial services space. So, for example, in 1998, the European Commission issued a directive talking about, hey, how can we reduce settlement, or how can we basically reduce risks in the settlement process? And their view is, hey, if you have a reversal of transactions that takes place after finality supposedly occurs, then you could have a snowball, a domino effect that creates systemic risk. And so I would argue that basically current regulations like Dodd-Frank and EMIR, the whole purpose of these is to reduce risk in the whole financial system and the clearing and settlement process. And by reintroducing probabilistic finality through a cryptocurrency itself, it's probably a non-starter for financial institutions as it exists today. Obviously, in the Q&A, we could talk a little bit more about what we call pseudonymous miners. If you don't know how mining works, again, we could talk about that during the actual Q&A. The term EULA, that's End User License Agreement, Terms of Service, SLA. There's because it's a public good and there is no actual entity to hire and provide these services, there's none of these, what we would consider contractual obligations between participants in a cryptocurrency network. So changing directions. If we actually look at funding in this space the last couple of years, you've had a basically collapse in venture funding in virtual currencies over the last year. And a lot of the money has instead gone towards non-cryptocurrency distributed ledgers, which is basically the industry that I work in. Here's a visual of this. This is over the last 2 years. You had a peak. Actually, if we could be really picky about this and dissect what happened in Q1 last year. But basically, you had a peak of VC funding. Maybe that changes again, but for now, it appears money is shifting into this other space. We would consider these companies here on these logos distributed ledger companies, basically companies trying to take parts of the tech and work with back office and middle office applications for financial institutions. They're not cryptocurrency related. And again, I could go through and I could talk to you about each one of these companies if you'd like during the Q&A. So a little bit about ourselves real quick. So the idea is this, is R3 looked for about 2 years, year and a half, 2 years, looking for platforms and tech that we could actually use for financial institutions. We couldn't find anything off the shelf, so we've decided to actually build our own effectively shared ledger for financial institutions. We have 42 banks right now. This next few months, we're hoping to expand to exchanges, clearinghouses, and the buy side of the whole system. And again, when we're building these systems, there might be existing tech, but that last point there, most of the tech was built for a situation or environment in which regulated financial institutions do not operate in. So if you're trying to build something fit for purpose, you might have to start from scratch. So some research questions you guys might be interested in. When you're building some of these networks, the trade-off between scalability and privacy is extremely important. Financial institutions will not use a network that doesn't have privacy. So the question is there a silver bullet to this? It doesn't appear so yet. There are some very interesting solutions from some of the institutions you guys work for, including MIT. There's something called Enigma. How much actual savings does take place? Like if you start shaving off a few bips, does that add up to be billions of dollars in savings, or is it just a bunch of marketing hype? Nobody's actually done the numbers as far as I know. When does definitive finality actually occur? Even if we build a system at R3, can you actually have settlement finality on the ledger? That's something that hasn't been decided by anyone as far as we could tell. And if you're building a network, how could you prevent governance from being centralized still? If the purpose is to create financial controls and at least prevent one particular party or one person from abusing the network, how can you do that with governance, some of this network? And lastly, FedCoin's a whole topic. In fact, I think across the street, they just said another panel. So if you're not familiar with FedCoin, the idea is this. How can a central bank like the Fed or BOE or BOJ effectively issue a state-backed digital currency? There's plenty of electronic money. In fact, I'm sure all of us spent all of our fiat currencies the last 2 days that were electronic, although I saw a few paper notes. The question is, how can you use some of this technology and combine it with a state-backed currency, a digital currency that's actual legal tender? If you're looking for one particular paper just to read over in your airport when you're flying back, I'd look at this last one, Centrally Banked Cryptocurrencies by Denezis and Meiklejohn. They're out in London. So that's, for the most part, FedCoin. We could talk about that during the actual Q&A. And I believe that's it. So thanks for your guys' time. I'll talk to you soon.
Thank you, Tim. Hey. Michael?
Sure. Great. Thanks, David. Thanks, Campbell, for having us. I wanted to just start off to pick up on the point that Campbell made in the introduction there, sort of just to address this question about why there has been, something of a paucity of academic interest. I think we and other institutions, and Duke as well, are at the forefront of trying to move this forward, but it's been a slow pickup, and I think that largely has to do with a misconception. And I'm going to blame both my old profession, the media, and in fact, the early adopters of Bitcoin, the currency, for this reason. I got very interested in Bitcoin in the early, when was it? So it was midway 2013 when the price was having this big kind of bubble-like effect, and I just immediately thought that this was a sign of a tulip bubble, and I was going to write some smart aleck kind of column about how pointless this whole thing was. It wasn't backed by any central bank. There was nothing particularly meaningful about it. And I started looking into it, and I think I rescued my column a little bit by recognizing that there was something fundamentally important underneath it, but still not really getting it until I was taken out for dinner by some folks who explained to me why the underlying technology, the blockchain, was this breakthrough in the way that human beings can exchange information of value with each other. And that in many respects, Bitcoin, the currency, was the first use case for a new system for exchanging information in a decentralized manner without the dependence upon trusted third parties as the intermediaries. And this was really something quite profound. This is really, if it is indeed implemented, and we're a long way from getting there yet, but if it is indeed the case, I would suggest that it's the biggest change in finance in 500 years. This undoes the system, or at least radically reforms the system that the Medici invented out of Florence. So that suddenly became a significant issue, but I still feel like that much of what was happening in the press was a focus on the currency, and we just wrote about the ups and downs of the currency, and we talked about how it was really not being adopted as a mainstream currency, and it was a poor competitor to the dollar for all these various fairly obvious reasons, I might add, the volatility and just the simple fact that there is no network effect in it, without thinking hard about what the underlying technology was. And I felt actually very frustrated covering it, because my editors keep on steering me on the hunt for Satoshi rather than the actual, what I think is a profoundly different paradigm for finance. And one reason I wrote a book about it and then ended up leaving MIT. But I do think that in some respects it was also the fault of the early adopters, not to suggest that they aren't extremely important in driving the interest in this technology and therefore for the birth of institutions like R3 and these others. There was a passion for the idea that we could create something that would usurp the Fed, that this would be, some sort of utopian solution to what, a lot of libertarians regard as, the curse of fiat money. And I do think it was a utopian vision, but often that's where change happens, right? At the fringes where these radicals come from, and then it gets adopted in the mainstream in a different manner. But I think that the combination of that perspective and the obsession with in the media with the volatility of the currency and the concept of who this mysterious Satoshi figure was meant that we really got sidetracked, and the blockchain really is the thing to focus on. I'm not going to get into this debate about whether or not you can or can't separate the blockchain from cryptocurrencies. It's a very interesting discussion around some of the points that Tim was raising about, how do you maintain the sort of, how do you avoid the centrality of the system that we're now trying to overcome, but at the same time create this functioning system that protects privacy and does all the other things that we need. Anyway, MIT's digital currency initiative is an attempt to kind of right that wrong, if you like, to sort of really start driving the research agenda around this. And we're doing a number of things, and we basically view the fact that this is a technology that has the potential to be really transformative, and as a result demands an independent research focus on this. There's a lot of venture capital that's gone into initially the Bitcoin cryptocurrency world. Now there's larger company money going into blockchain research. We think it's really important that independent research is done around something that is ultimately about the infrastructure. It's about the underlying infrastructure of our financial system. It's critical that there's an independent component to how the ideas around this shape out. So we're doing a number of things. One of the things that we're doing is actually funding a couple of the Bitcoin core developers along the lines that whether or not it's going to be Bitcoin or not, it's important that this core protocol is developed in a way that is funded in a rather independent way. So money is steered through the MIT Media Lab to fund the salaries of 2 of the 5 core developers who have commit access to actually adjust the protocol. Interestingly, they are both on either side of a very big debate right now inside Bitcoin, which I think is a reflection of our neutrality on these things. But beyond that, which is just really the initial project, we're really looking at trying to roll out the research agenda in a couple of different areas. One is to just look at the core fundamental research, to look at the infrastructure underneath it. And so Tim mentioned Enigma. This is a layer on top of the Bitcoin and layer on top of the cryptocurrency protocol that helps to address questions of privacy on what is ultimately a transparent ledger. This is one of the great, I think, misunderstandings as well about Bitcoin, is everyone thinks it focuses on the anonymity that's associated with this, and it really is pseudonymity of the users, when in fact one of the most profound features of the blockchain is that it is transparent and open, which causes problems, of course, for banks who aren't very keen on the idea of having all of their positions exposed to each other. So systems like Enigma, which is developing out of MIT, work to deal with some of those core issues. And so we're looking at that, but we're also looking beyond the technical side, and we're trying to bring in economists. We've got Simon Johnson from the Salon Management School, that many of you would know, and a number of other top economists at MIT starting to take great interest in this and working with us on things like an economic impact report we're trying to build out. We're getting around 50-odd students at Sloan very interested in building out a big report on the various ways in which the global economy could be impacted by blockchain. We're looking at financial stability, questions around the impact of what might happen in a real-time settlement world to financial stability, and some of these broader questions around finance. But the area that I think I'm most interested in is the one that I was sort of most driven to get involved in, was just this question of social impact, because there's a view that the blockchain can be used to achieve a whole lot of goals that aren't necessarily going to be pursued by the private sector immediately. And I think they fall under a number of different categories, but the broad rubric is really financial inclusion. This is the idea that, in various ways we can use this technology to bring the 5 billion or so people who are excluded from the global financial system into it. And I'm just going to highlight a couple of the areas that I'm particularly interested in, but there's a whole lot of them. And this is, I think, one of the ways in which, again, there's not a great deal of understanding about how this technology goes a lot further than just Bitcoin, the currency. And one is asset registries. And so we're looking at the idea, this is built around the idea of Hernando de Soto, the famous Peruvian economist, on the role that poorly managed registries of property title impact the capacity of the poor to monetize their wealth. And so, the idea that you could transport, if you like, details about the physical world in a digital form and insert that into a ledger that is managed by some sort of decentralized and so much more reliable and immutable ledger like the blockchain, means that you could potentially leapfrog away from this fundamental problem that really is deeply ingrained in the informal economies of lots of the developing world. And so we're looking at different ways in which not just land, but also movable assets with the use of new advanced kill switch chip technology could be used to create these notions of smart property and give a lot of confidence to financial lenders to lend against what otherwise would never have been regarded as security. There's this concept of digital rights management, so the idea that you could copyright a song or a digital photo and have that inserted into the ledger, and therefore create this permanent provenance of title record that can be used to build smart contracts on top of for the purposes of payouts in terms of copyright. And then there's just generally ideas that some of this gets down to how states and governments could use this technology. Once you start thinking about the smart contract properties of what you can do with a blockchain, this is programmable money. You start to think about how welfare, for example, could be managed in an efficient way, how this more transparent form of issuing welfare payments with the traceability that comes from this blockchain and the capacity as well to actually not just money itself becomes a contractable part of the transaction. So you can basically program a payment to do one thing and not another. So it can only go to pay for groceries and not for beer, right? Some of these are the ideas that are being developed right now around this social impact side of things. But just broadly, I'd just like to make this final pitch as well, and I outlined it in a blog post that I put up today just to try to make the case here as to why economists really should be getting into this. I mean, one of the main things for me is this is a treasure trove of data. I mean, we currently, I covered economics for years at the Journal, and you're constantly dealing with the fact that there is some degree of sampling error in any level of macroeconomic research, and there is obviously a time lag. Well, this is an economy in its own right that has all of that data right there for you in real time to use and to work with. Not only that, because it's open source software, you could create simulated versions of it to run, Vernon Smith-like experiments on what happens to different actors working in this kind of environment. There's all sorts of different realms of economic research that can be done here. I do think it's a great pity that Ken Rogoff's panel is currently underway right now over at the Hilton, because the questions around what might happen with monetary policy in a state-backed digital currency are really interesting. I mean, the idea that simply just for an academic research question to ponder whether or not you could program into a digital currency some form of ideal monetary policy instrument, some sort of rule into the way that the velocity of money and other components of an ideal monetary policy could be programmed. All of these things, I think, open up a realm of possibilities, and we at MIT are just really eager to work with other institutions on how we could build out some really very interesting and very important research in this field. So I look forward to maybe chatting with some of you later on. Thank you.
Okay. Thank you very much. Morgan?
Great, thanks. So I'll cover in my opening 3 high-level topics, right? I work at Citi, so I'm at a bank, and I'm actually trying to implement and managing cross-border payments, and we've talked about Bitcoin a bit. Bitcoin is one of its benefits is it transfers value. It's a new way to transfer value. So what is Citi's mission, and how does blockchain fit into that? So we want to be a leading innovator in this space. We think it has transformative potential in the future. But so I can give some high-level comments about what Citi's doing in the space across all of its businesses, and as well as the challenges that we've seen to actually adopting the technology, some very real-world challenges that I think pose some interesting research opportunities for you guys. So big picture, our mission is to enable progress for our clients and growth and economic progress. And it's very early days in blockchain, and it is a bleeding edge, but there's a lot of focus and energy on trying to leverage it, and Citi is a good barometer in terms of how could you bring in this leading or bleeding edge technology into a very large organization to improve our products and services, to create new businesses, attract new customers, drive more value, reduce costs. There's a lot of value that we see in blockchain. So what exactly are we doing? And Citi has a long history of innovation, right? From the first ATMs in the 70s and 24/7 banking to establishing an FX department way back in the 19th century, and funding a lot of things like Panama Canal and the first transatlantic cable. There's 200 years of innovation. So we're taking this quite seriously, and we have a lot of smart experiments, testing and exploring across all of our businesses. So if I had to talk about how we're doing this, I'd say it's in 5 key areas. The first is testing and exploring to build our capabilities. We're trying to build certain things in-house, but we're definitely going to have to work with partners, and that's why engagement with academics, with innovation labs outside of Citi, with fintech startups, with VC firms, et cetera, are all very important for us to realize the promise of this technology. There's absolutely no way, I'm absolutely convinced Citi could do this on its own, or any major institution could do it. It's just too nascent. The second pillar is a range of partnerships that I talked about. We've established a digital money readiness index with Imperial College. That would be an example of a partnership where we're really assessing how can a digital currency come online that is adopted and used by customers, and what markets are actually ready, what have the infrastructure, what have the participants, the support of the private sector, the solutions that make sense to consumers, et cetera. The third pillar is making strategic investments into startups that we think have complementary value, could be leveraged by Citi. We could learn from them. And so, for example, we recently made an investment in Chain.com, which is a blockchain service provider, right, that would help a company like Citi or other very large institutions bring in blockchain technology and actually implement it. So we see that as very complementary, and we've been working with firms like Chain to see how we could bring in this technology. The third is regulatory engagement. This is a very big area, and it's a potential research area. There are new legal questions. There's new regulatory frameworks that probably have to be developed in order to protect consumers, protect the public, and be adapted outside of the traditional financial system that we've developed to date. So Citi has been engaging significantly with regulators to figure out what new risks are presented, how do we address the open questions. Tim talked a bit about some of the finality of settlement, et cetera. And then the fourth is thought leadership and industry initiatives. Cities participating in R3, where Tim is representing. We also work with IDEO, which has partnerships with MIT. And so there's a trade initiative. Again, there's a lot of industry collaborations because blockchain is inherently a network technology. So you have to have an ecosystem of participants. Nobody can go it alone. And building up that network is one of the key challenges to adopt the technology successfully. So if I just dive in a bit to some of these pillars that I talked about, what exactly are we doing at Citi? And just to caveat, I manage our cross-border payments business, and that obviously has a very real implications from blockchain. But we have our markets business, we have our consumer businesses, we have a Citi Ventures arm that invests and helps accelerate, and we have a number of innovation labs around the world that are helping us test and explore this technology. And testing is really esoteric, right? What use cases are possibly out there? And Michael shared a lot of potential use cases, and the list is pretty endless, actually. That's what's so appealing about blockchain, is because beyond financial services, there's a lot of interesting applications and use cases. But now we're kind of in the cold reality of how do you actually pick the best one, the ones that are most appropriate, because there's a lot of ways to skin a cat, right? And if Tim talked about doing the pros and cons and how much money will you save, right? If we adopt blockchain in trade settlement, how much does that cost and how much will it save? And it's, for commercial enterprises, that's going to be part of their determinants about how and whether they bring in blockchain and where. So that's the testing bit. The exploring is getting kind of down to real world use cases, and that's where certain parts of our business are, where we think there's actually a real world application that has enough benefits that we think we can adopt it, and really testing that viability, pushing and prodding it, et cetera. And so we have a number of different use cases, and maybe I'll highlight them a bit. And just to give you guys a background, since all of you all said you know about blockchain, but what are some of its benefits and promises? I think the first is, we talked about it creates a decentralized, you take out the middleman in some cases, which has benefits. There's fewer hops, there's better information. You have a single source of truth that's shared by everybody, so you eliminate reconciliation. Again, and this is all in the nirvana state, but it is some of the promise of blockchain. You give asset ownership to the holders instead of holding it in a central institution. So you could hold your securities on your mobile phone, and that gives you more ability to transfer them, to see them, to record them, to share them, et cetera. It just gives you more ownership over your assets. However, that has pros and cons. If you lose your phone, it's like losing cash. The money's out the window kind of thing, unless, again, you have some kind of backstop, like a bank that keeps your keys, your digital keys, for example. So I do think financial services will evolve in very interesting ways as we get along when we think about some of the benefits. So another question I get asked is sort of what are the high-level benefits of blockchain as you think about use case categories? And it might be helpful to lay out that context a little bit. We want to have it as a new rail to transfer value. For the first time, and the payments rails haven't really been changed materially for the last 40 or 50 years. So you now actually have a new rail, and it's kind of like mobile phones versus landlines. It's a new rail, and that creates new entrants, new opportunities. So that's one key area of blockchain applications. The second is the asset ownership, again, to create and transfer other digital assets beyond a specific currency. It's a way to automate and govern contractual terms. Michael talked about smart contracts, smart money, smart property. This helps embed a governance, a automated governance of transferring things. And then it's a mechanism to enable integrated solutions like identity management or voting and governance. So it enables integrated solutions where people can look at it for multiple purposes is kind of the easiest way to share it. So use cases that Citi is exploring actively, I would say, is in cash and trade business at Citi. We moved $3 trillion worth of payments a day. You guys might know the FX market is $5 trillion a day. So these are huge markets, but we definitely think that blockchain can increase the speed, it can increase the transparency, it can reduce the cost in cross-border payments, as an example. In trade finance, 97% of trade is paper-based. It is still, one of the old school kind of infrastructures of the world. So can you digitize parts of that from a trade finance supply chain point of view? In the markets world, we are actively participating in R3. I think there is a view that we can reduce clearing and settlement by having real-time settlement or near real-time settlement and avoid all this reconciliation that happens across all the banks. And then in consumer, some of the applications that, again, at very different stages of development, but it could be even things like loyalty points. You guys probably have all kinds of loyalty cards in your wallet. There should be a fungibility of loyalty points, ease of use, ease of conversion, ease of monetization. Things like peer-to-peer payments is obviously a big one in the consumer space, and micropayments. I guess if I have to highlight from a payments point of view, the world is becoming more and more global, and that means there's a lot of interest in transacting even very small amounts, whether it's around intellectual property rights, it's the Internet of Things. The payment size is getting smaller and smaller, and our existing payments infrastructure is not good at handling small payments. Very big picture, we handle high value quite well, generally speaking. And so as the world evolves and you see all these micropayments around donations, paying for, if you give a recommendation, a small amount, we need an alternative, and I think people think that blockchain, around, as well as financial inclusion, can help make a new infrastructure that helps support smaller value payments. So on partnership and industry initiatives, I would just say we're mentoring a bunch of startups. We have a plug-and-play accelerator program, fintech in Israel that, again, so we're mentoring a number of startups to get intelligence, to share our expertise, because we know how the existing rails work of the financial system, but bring in new ideas of how to do things and what some of the startups are working on. I talked about the Digital Money Initiative Readiness Index. We have a symposium every year, and again, I think the index went up slightly over the last couple of years, but in a very small way. So the world still has more to go around digital money, and there are a lot of very interesting questions that does need independent research, I believe, to help make that a reality. A number of governments and central banks are focusing on it. Let me talk a bit about the regulatory engagement, and then I'll get into the challenges. Citibank is a SIFI, right? Significantly important financial institution, and so we have an obligation to help work with and desire to work with regulators to make sure the financial system is sound. So Citi was the first participant at a Department of Justice on blockchain symposium a couple months ago, where Citi was the only bank that presented, was invited to present. But there are a lot of different interesting questions on the regulatory side, including fraud and consumer protection around Bitcoin or other digital currencies. Complexity of crime investigation in the digital space, right? Everybody's thinking about how do you monitor that you're not putting bad money through the pipes, right? Whatever the pipes are. Evolving regulatory approach to digital developments. How should regulators work with fintech startups? What are those models? And the outlook for blockchain and financial services. So there's a whole regulatory prong. So let me end on the challenges, and this is where you guys, we need your help. And there are many still, because it is so early. The first is determining the optimal use cases. As I said, the list is endless. You can think of it, just seems like a nirvana when you look at what blockchain can do. And now you have to get into the cold, hard reality of where do you spend the time and energy, because it's a lot of work to adopt it. So the pros and cons, the economic benefits, I think that needs a lot more research. Technology is not yet industrial grade, even with these fintech startups that Citi, let's say, would have to use or want to work with. That infrastructure stack is very nascent, right? The coding it's under can be hacked. Again, we're talking about money, and we need to protect that money, however it's being moved around. The third is you need to change business processes. You can't just plug in this technology, because the whole interesting thing about blockchain is it's sort of like a super database. It keeps the information, but then it can automate certain processes on top of the database that we use today. So we use a whole bunch of databases, and then there's a whole bunch of reconciliation across those databases. Blockchain can kind of collapse that, but that means you have to change your business processes, which takes time and energy. The third is, or fourth, sorry, integrating into legacy technology or switching over will be challenging. Again, we think about these massive ledgers banks build up and have, and that's, these are huge systems. If we have digital currency, how do we make sure those ledgers are updated for 100 digital dollars issued by the UK government, along with the rest of the fiat currencies around the world? So integrating, I think, will be a challenge, or turning on the switch. Again, you'll have to think about managing that. We talked about building an ecosystem or network of participants. It has to be interesting. You have to work with a lot of stakeholders. That takes time. And then In cross-border payments land, one of the constraints is there's always a last mile problem. You guys ultimately want cash in your bank account or cash in your hand. And so unless you transact end-to-end, meaning it ends in a cryptocurrency or digital currency, you don't get the full benefits of blockchain because there's still that last mile that has time lags, has costs, et cetera. So until I think state-backed digital currencies come online, it'll be harder to realize the full benefits. And then the last is around, I think, on the governments, on launching a digital currency. It has profound implications, social, behavioral, infrastructure. So again, it's not that any of these can't be overcome. I do believe they will be overcome over time, but it needs work and energy to figure out the best way. And then this legal and regulatory framework, some of the questions there, resolving those, I think, will help us adapt blockchain and take advantage of its benefits. So I'll leave it there. I think promising technology, many obstacles currently to address to fully leverage the promise of it.
Hey, thank you very much. I'm going to open this for audience questions in a moment, but I wanted to ask one or two of my own. One of the real interesting aspects of the blockchain is that the governance is completely decentralized, that when you wish to change the code or one of the key variables, a change can be proposed by anybody, and then it's adopted by consensus, basically a decentralized democratic process where 51% or more agree that this is a good idea. Now, I'm wondering how this works in the cooperation among financial institutions and organizations such as R3 and others as well. R3 currently has 42 banks, including Citi, and it's been expanding. I think it began in the fall with 15 banks, and these are major players, the major money center banks from around the world, and they've been adding 10 or 15 per month, roughly. I'm wondering who's the gatekeeper who says that this bank can be in, and then when the banks disagree, do they vote? Is there a benevolent dictator? Can people withdraw? How do these things get sorted out in a way that is consistent with the idea of consensus?
It's a great question. So basically, we make all the banks buy Bitcoin and then give it to me. So the question of governance, so we have obviously, we're not the first people in the world to create a consortium, and we're not the first financial consortium. There's CLS, there's SWIFT. So we do at least have some precedents to go by in terms of how to build a governance structure that works. As far as institutions to add, okay, right now our membership is actually closed. We actually have, I think, twice as many banks as we have employees. So that's obviously a fun task to try and handle. I was actually just out in Asia meeting some of the banks for the first time out in Japan 2 weeks ago, and so it's interesting meeting these different, obviously. The way they work is obviously different than way things operate here in San Francisco or New York. But yeah, short answer is, it is member driven, so they come up with their own criteria. But we are trying to be very pro-competitive and very open towards new and different financial institutions. As I explained, in the next couple months, we hope to include clearinghouses, exchanges, buy-side institutions. And back to what Morgan was saying, this technology is really only useful if you have more participants. The more the merrier, basically. So for us, we see the open standard that we do create will be used by a variety of different institutions and not just 42 banks.
The other thing I would add is, and this is one of the reasons why blockchain seems so appealing, is you can design the network, right? So in a permissioned network, you can determine the consensus mechanism. So it's not 51%, it's 8 of 10, 9 of 10, 7 of 12, whatever, right? So I think in any industry consortium, the consensus methodology will be very important to agree, obviously, and that is a variable that can be adapted based on the use case, right? How much do you trust the other parties, et cetera, right? So you could have different consensus mechanisms, in short.
I'll just add one more point, because I do think this is just another area that is absolutely ripe for research, because what we're talking about, in my mind, is a continuum of decentralization. So it's clear that something purely decentralized, and even that's obviously, I think, in inverted commas, like Bitcoin, has governance problems. It's just very hard to get this consensus, and we're seeing this in a big debate that's underway right now about whether to increase the block size on the blockchain. And there is also some risks associated with that as well in terms of whether or not there could be some sort of collusion or capture of the system. But then the other extreme, of course, is complete centralization, where Lehman Brothers is the only one that knows what's on its books, and even then didn't even know what was on its books. And so somewhere in the middle of that, there's an ideal world where I think, and there may be for different industries and different use cases, different ideal worlds. And I think that the structure of the validation network, the institutions that are validating the network and how they interact with each other, what are the governance rules around that? What are the array of aligned or misaligned interests that may or may not, infer that there's a possibility of collusion to that? These are hugely important questions, especially if, as Morgan was suggesting, we may well be building the new back office of our financial system. So the structure of the governance of these blockchains and how we actually design that along that continuum so that we don't end up with another 2008 where centralized institutions end up blowing up the world, but at the same time we have something that's a little bit more workable than the kind of rather noisy affair that Bitcoin is right now. That's a very, very important question.
Now, just in the month of December in corporate finance, 2 events happened, which I doubt very many people in the room are aware of. But one is the first company registered, this is Overstock.com, registered a prospectus with the SEC to issue debt securities on the blockchain. So a number of people are nodding their heads. This would be the first blockchain bond where they're trying to opt out of the corporate debt markets and create a new way of essentially transferring and recording these assets. And on the equity side, the NASDAQ has a pilot project to use blockchains as an alternative to the clearinghouse and share registration that is used pretty much exclusively by the exchanges now. And I think just last week, Chain, in fact, became the first company to put itself out there and have its equity listed on the NASDAQ blockchain. And I think the idea of NASDAQ is to put the New York Stock Exchange and the real NASDAQ out of business with this. It won't happen tomorrow. But a question I'm asked an awful lot is how quickly are these things going to grow? When will they become too big to ignore for academics and begin to crowd out the data on the financial pages? I'd welcome perspectives from any of you guys about this. I think historically people are pretty good about identifying the potential of new technology, but pretty poor about the timing, about when it actually is going to come ashore. And you see mistakes of both types. Either people over or underestimate how quickly it's going to gain critical mass.
Sure, I could jump in if you want. I think that if we're going to use analogies, we're kind of still scalping tickets outside the baseball stadium. Like, we're not even at the first inning yet. And we could see that through just numbers. Like when I had that question about some open research about how much does it actually cost to switch off systems that you're supposedly replacing, nobody's done any research on that. So the consultants, for example, we need to work with them, whoever we are. Obviously, R3 will be eventually, if we do our job right, because they're the ones who get integrated at scale. And nobody's actually built a blueprint. So until we've figured out, number one, what the costs are, what the switching costs are, and most importantly, the total cost of ownership, but how this actually will be deployed, until that's actually done and we have production systems running in parallel, which hasn't happened, I think we're several years away, at least, from a number of even simple systems. So when we hear like low-hanging fruit, that could be the case that there is no such thing as low-hanging fruit. It's all going to be a hard slog. I hate to be cynical like that, but like let's be realistic too. I mean, there's been a lot of hype. So my own view is there might be some easier wins, maybe with cross-border payments actually, but for the most part, trying to replace the derivatives trade, like the clearing and settling of derivatives is probably not a very easy process, at least from what it looks like right now.
Let's just not forget, though, that this is open source technology, right, for the most part, and then there are obviously people building proprietary systems, but the principle around which R3 is working as well is open source, and that creates almost unforeseen innovative capacity. We're talking about potentially the entire world being able to contribute to the development of ideas. And it is one of the reasons why we have seen such rapid innovation in this space, as well as, of course, what we see just generally in the digital economy. And obviously being here in San Francisco is a pretty useful environment in which to reflect upon that. But I do think that that's one of the things that makes this very hard to judge. It's all very well to model what one company might do, and I really appreciate Morgan's point about all the business processes that are going to have to change, and that is indeed a hard slog. But the innovations that are coming very, very fast, and the decentralized nature of the financial system under a blockchain environment is happening in parallel with all sorts of other similar forces that are happening throughout the economy. And I think it's very hard to model what all of those confluences of forces are going to be in terms of how fast some of these things come into being. I think we'd be remiss to assume that there aren't big changes coming in some form relatively soon.
I mean, what I would just add, I think, to replace very large-scale systems, it will be many, many, many years, I think. But I agree with Michael that in the case of NASDAQ, they chose a very periphery market, private market securities, right? So that's sitting in lawyers' drawers, right? Who owns what? And if you can create the asset digitally, then you can start tracking it and trading it, and it's minimal disruption to their existing huge platform that settles equities on huge scales. So I think on periphery instances like that, where it's related to the core business, but it's very small in scale, that could be done a lot more quickly, as per the kind of announcement that they're launching. With the unbanked, I think there's a lot of impetus for new models and new business models because there's not an alternative currently, right? So it creates, there's lower cost of entry because there's no infrastructure already. And so you see companies like an Abra if they want to take out cash, replace it, and basically use Bitcoin as the rail to send money around the world using a mobile number, right? And that's a compelling use case for P2P remittances, where they can lower the costs, they don't have to rely on infrastructure, they don't have to build it, et cetera. So I think it's hard to cover it in a broad, in a broad-based brush. There definitely will be fast adoptions in periphery or places where there isn't an existing alternative, but then to replace core platforms of the underlying financial infrastructure will take much, 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 much longer for the reasons I cited.
One of the things interesting to me is the way that technology startups today are avoiding the public markets. You read almost weekly stories in the Wall Street Journal, the Financial Times, about how these unicorn companies that are supposedly valued at more than $1 billion don't want to go public and are avoiding IPOs in the classical sense. My own belief is that one of these companies is probably going to put their shares out there on the blockchain, and maybe sooner rather than later, and that may become a catalyst for other firms. I think the two big fish in this whole game are obviously Airbnb and Uber, but there are plenty of other candidates as well. It would not surprise me if sometime in the year ahead, one of these fairly well-known, rather valuable firms opts out of the public markets as we now know them and decides to go in a different way, but we'll see. Let me invite questions from the audience at this point. Yes.
Okay, so one of the things that strikes me about the whole discussion of the financial system is it's very much dominated by financial institutions. Dominated by financial institutions, and in some areas where I'm working on trading, it strikes me as asking the financial institutions to dig their own grave, because in areas such as leaders where they have to manage the trading, they actually will be in large part superfluous when you have blockchains and property leases. It's when you take big blue sky thinking this is a definite possibility. And one of the things that we said was very interesting, saying it takes years to replace the existing system, which is extremely sad if you think about it. So there's some areas where there could be huge efficiencies, such as corporate bond trading, where if initiated and done properly, there's huge gains which we have huge economic benefits. The question to Michael would be, now what we basically doing at the moment with R3 is we're asking the taxi industry to find the right system for organizing the allocation of taxis in an economy or in a city or across multiple different cities. But what we really need is an Uber company which comes in and just pulls that all out and says, here is this much more efficient technology that is extremely easy to use. We see that happening.
It's a really good question, and I think that what it requires to some extent is a crystal ball, because what we're actually maybe facing is that the very notion of what finance and payments is maybe shifting outside of the banking system itself. Right? There's a whole other conversation about what fintech is and the use of apps, and whether or not in the Internet of Things world we end up where micropayments are being automatically sent between each other by gadgets and the like. These are all these kind of interesting ideas, and whether the banks get shifted out of that. So I don't know which big mega player, maybe it's Amazon, right, who's going to position it, but this could be just as big a problem as having another centralized institution. I think that this project is called Open Ledger, that we still don't quite know exactly what they're going to be doing, but they're basically a consortium as well that's bringing in IBM, Intel, Cisco, and the Linux Foundation to build to develop some notion of how the standards could develop around this will be instructive. As to the banks themselves, though, I think one of the things to remember is that I used to cover foreign exchange, and I also covered the early stages of finance over the internet, the late 90s, and I was so struck by all these this concern that Wall Street would be destroyed because their pricing models were going to go away when all the prices got broadcast over the internet. And it turns out that there was greater volume of trading, and banks did just fine. They created their own consortium and developed their own in-house online trading systems and matching systems. And sure, the spreads have come down significantly, almost to the point of zero in some cases, but there's still business to be had in terms of the volume. What happens is there's disruption in some sectors of the financial sector and others not. So the way I kind of envision it, as I say, this is crystal balling it, so who knows what, but I do think that there are some of these legacy systems of banking, to your point about asking the taxi companies to design this, where they're just going to have to say this is going to go, right? So correspondent banking as a model seems to me to be a big waste of time. We should just be able to send money from one regional bank to another regional bank, another part of the world, and not rely on the big custodians to sit in the middle of that. Settlement, does the DTCC go away? These are sort of key questions. On the other hand, my vision for what asset registry is, that we take the 2.5 billion adults in the world who don't have access to banks and are outside of the system, we put their assets onto the blockchain so that they can be collateralized. Well, that's a giant credit market just waiting to be tapped, right? So you could get very utopian about this and say, wait, what we're going to do away with is all the redundant rent-seeking payment, model forms of banking, and get banks back into the business of actually lending. That might not be such a bad thing. The question is, and I think probably a bank like Citibank's probably better than others able to do this because they've got so many different arms that they can trade one off against the other. It might be a lot harder for a BNY Mellon or a State Street or one of these others that has a very specialized role within the banking system. I think those are ways to address the question you were asking.
And maybe the other way I might add to the comments, I do think blockchain is a catalyst for banks to improve their services in different ways, right? Because it points to an alternative. And banks, I think, can probably do a lot of those changes. There's a SWIFT initiative underway that wants to make the fees transparent, right? Wants to provide tracking, wants to do same-day value credit to the beneficiary to address some of the benefits people see with blockchain in a different way without using blockchain, right? So I think it's probably maybe in some ways, I don't want to call it a race, and it is hard to predict, but banks, it identifies pain points and an alternative, and it's a catalyst for banks to improve their products and services. Now, whether that protects its existing, kind of revenues, that's another big open question, right? And I think the consumers of all kinds will benefit from this, from blockchain and the improvements that banks make outside of blockchain. So, I think there is some element, it's hard to disrupt yourself, absolutely, but there is a lot of stake. And the last point I would leave you guys with is, my business alone across cash and trade hosts 500 billion of corporate and institutional clients' deposits. I mean, this is money we're talking about. So it's kind of easy to think about it, would you keep all your life savings with Amazon? Maybe down the road you might, but it's a different type of good that requires greater protection and certainty for most participants. Now, some on the fringes might be very comfortable with that, and millennials might be uber comfortable with that, right? So down the road it could change in terms of who really holds your value, right? Your assets, your value. But I want to just keep that in mind, right? That it's money. And would I keep my life savings in Amazon today? Not yet, no. I'd keep it with a bank. But things will change over time, potentially.
Cam?
Yeah, I could respond to that too if you like, since that was kind of right at us. So, at the end of the day, the question is are banks going to disappear? If they're not going to disappear, and they're still around providing services, and they realize that there's technology out there that they could adopt, why would they not adopt it? So, we can make fun of entities that are slow. There's taxis are still around. I don't want to necessarily compare R3 with the taxi company. I don't think that's really fair. But I mean, if the technology is open source and open standard, there's these like 20 years ago, you had a group of Linux free open source guys going around saying, we're going to destroy Microsoft, we're going to destroy IBM. And all that ended up happening is they built effectively free code and free libraries for these very enterprises that exist still today. So I'm not saying that banks will always be around or financial institutions will always be around, but if the ideas are out there and they're open, then I don't see why enterprises won't integrate some of those for their own utility.
Can I just make one last point here? This is one worth thinking about. I think possibly the biggest disruptor to banks could be state-backed digital currencies, right? Because all of a sudden you are, the CFO or the treasurer of XYZ big Fortune 500 company, and you've got some money you need to park for a couple of days. You're not going to give it to Citibank anymore. You're just going to give it to the central bank, right? So access to central bank money through digital currency could be a profound change in the way that large money markets function in terms of short-term payments. And so there's a lot of challenges out there. Anyway, that was it.
Yes.
Just had a question for you. Not let's set aside the maximalists and talk about specifically with blockchain technology and the implication for banking. So when you have transparency, have you at Citi considered walk-through use cases, not for blockchain as a technology, P2P database, but for the business of banking? Have you walked through that thing? Because when you have P2P payments, then there's not going to be liquidity, which is no float, right? And there's no retail banking necessary. Because the gap between retail investors and institutions goes directly. Have you walked through the use cases of those and considered the implications for the bank?
Yeah, no, it's a great question. I should caveat all my comments that Citi's a big place. Sorry?
Could you repeat the question back?
The question, as I understood it, has Citi considered the business model, the use cases that are most impactful, as I understand it, as well as the business model implications of blockchain, meaning what revenues might be reduced, maybe clients don't need to keep cash with Citi anymore. Did I understand your question? Okay. So very big picture, I think we've spent a lot of time across the company on use case thinking. So where could blockchain be applied potentially? So I think we've done a lot of that thinking. And please note that I can't speak on behalf of Citi, 270,000 employees, but and sort of the Citi, there's not one perspective at Citi on this, right? So I'll share my own perspective. I think the business model implications have been thought through at a high level, but as Tim highlighted, it's very hard to, first you have to understand blockchain well enough to know what costs it would take out, et cetera. And then you have to look at the alternatives to blockchain to delivering those benefits to clients, faster settlement times, cost reduction, and there might be many other ways. So you have to do a pretty extensive analysis to say, yes, in these three places, I want to use blockchain because I'm going to save 10% or, so I guess my point is the business model is still under work, right? Certainly it will provide pressure, greater transparency. That's why I said at the outset, consumers will benefit from this. Businesses and corporate clients will benefit from blockchain irrespective of what Citi adopts within blockchain because we're going to, it's a force for innovation and improvement, right? And oftentimes the cost comes down, right? So I think in short, I don't think we have worked out one number for every use case yet on pros and cons, and that's still a lot of the work that needs to happen. And it's not just a Citi perspective; it's how much across the banks, for example, could you take out? And I think Oliver Wyman estimated something like 20 billion in savings by 2022 around trade settlement, for example, right? But that's just the first stake in the ground around it, and a lot of things have been learned about how hard it is to implement. Does that answer your question?
Yeah. Point specifically. Banking depends on borrowing from one person and
Yep.
lending to another, the gap between what you pay
Yep.
person. When you have transparency on this, right, the retail side of banking disappears. I'm saying the implication of that is that the retail storefront, retail banking, the people going to make deposits, the eventual picture goes away, doesn't it?
Well, again, it depends on where you want to keep your money, right? Do you want to keep your money on a phone your life savings there. So I don't necessarily buy the premise that retail banking goes away under any circumstance, even with the most optimistic view of blockchain. By the way, how are you going to spend digital currency? Merchants have to, this is the whole ecosystem we were talking about before. If you have, 100 Bitcoins on your wallet, well, in order for that to be a functional currency, right, and not to need a cash deposit, you have to be able to spend that 100 Bitcoins somewhere, right? Merchants have to accept it. So there's a whole ecosystem that has to happen that I don't believe will happen it's not binary either, right? People will keep cash deposits from a retail point of view, is my humble perspective.
I like this question a lot, but I'm sure you realize that Citibank is the last institution in the world that is going to agree with this point. Camp?
I'm wondering if the panel could address the risks of blockchain. And indeed, it's kind of confusing because we're talking about putting billions of people's life savings on the blockchain, but it's not obvious even what blockchain is. So is it permission, non-permission, public, private? Are there going to be millions of blockchains? What about the security of these blockchains that are not public? We know what the security of the Bitcoin blockchain, and I'm pretty confident that with 800 million gigahashes per second, but with these small blockchains, I'm not as confident. So how do you see this playing out? It seems like a wild west of blockchain right now. Operated very loosely, and it's not really defined. So how do you see it playing out? And I do have a follow-up, brief follow-up.
Okay, yeah, I'll start. I'll take it if you like. Again, this is where we're crying out for research because these are huge, huge questions. I think one of the interesting, I like talking to the guys at Chain.com. So Adam Ludwin, I think, came at this originally from a Bitcoin world. I wouldn't say he was a Bitcoin maximalist, but he was very much of a believer in cryptocurrencies, and he's now kind of worked his way into a world where he's designing these private permission blockchains. But I think he's got a fairly healthy perspective on how the goal is interoperability and to find ways in which you can create systems of sufficient trust and realms in which we know we can create. So if it's a private blockchain, what is the structure of that system? Who am I trusting? And can we and the participants in that recognize that? And how does it interoperate with another public blockchain? And I basically think that we're going to have realms in which we'll happily have a bunch of banks be the blockchain if it's sufficiently governed in such a way that we can feel that the process is secure. But that may well be for classic wholesale financial settlement. But what might happen in an Internet of Things world where we've got just potentially billions of devices talking to each other? We really can't have Amazon sit in the middle of that, right? It's almost to me seems we have to have a very public blockchain, one that is going to be somehow managed in a sort of a way that is very secure around this sort of principles of decentralization. And how does that interoperate back to the banking system? So, again, I don't know the answer, but these are really just critical questions about where the interconnectivities lie and how, in some form of security, can we move from one to the other, and create these trustless exchanges. Ripple has an interesting project called Interledger that they're developing, which is using the principle of escrow in an automated way, where it locks up a relationship between two parties on one side and then two parties on another, and you can effectively, therefore, exchange value from one ledger to another. And that sort of starts to talk to this question of interoperability, and at the same time, some notion of how what forms of trust we're going to build. The key word is trust, and what exactly we mean by that, and what we can feel comfortable with. That doesn't really answer your question, but
So I'll give it a shot as well. So raise your hand. Who's heard of a term in economics called the hold-up problem? Has anyone heard of the term? Okay. So the hold-up problem is you guys could feel free to yell at me because I'm sure you lecture to your own students about this. But the long story short is it's a theory of incomplete contracts, basically in which one party has leverage over another. So if Apple, for example, likes to have multiple vendors in their supply chain in case one goes out of business or has a flood or something like that, so that way they're not beholden to another vendor who could have that extra leverage to renegotiate the contract. With public blockchains, and I had a paper that's came out. If you look at Appendix B, this is what I talk about. One of the problems with looking at using public blockchains for regulated financial instruments is that miners as a whole are going to be rational, and if they detect that there's a certain amount of extra value that's being trying to be transacted or trying to be secured on the network, they're going to do rent seeking effectively, because that's what a rational entity, a rational miner would actually do. No, nobody's actually done this because the actual value on the network is actually really low, relatively speaking. So as far as like securities and risk, I would say that there's trade-offs. Irrespective of what kind of network you use. Obviously, I could go on. We could have a whole panel on just like what are the different security mechanisms, the consensus mechanism, and so on and so forth. It could be we could nerd out if you want about all these different ways of securing networks. But the long story short is, at the end of the day, regulated financial institutions are going to have to go through a process of vetting of this technology. And right now, at least at R3, we see permission blockchains or private blockchains as the way to go forward with that. Obviously, this is a whole discussion we could have for the next couple of years. So that'd be my quick answer to that.
Yeah, and I think it's a great question because it's very hard to answer, right, in short, meaning it's just like understanding the business case implications. Things are still so early stage that there are many risks we think we might understand with blockchain, but they're not all known yet because there's not emerging standards per se yet, right? I do think because it's a network technology, you have to have critical mass. So you won't have millions of blockchains in my humble view. Maybe, in 20 years' time, yes. But for certain, for land rights, you might have an established one that there's 3 blockchains around land rights. Do you know what I'm saying? You won't have millions because you need participants. And to attract participants, you have to have governance. You have to have an agreement on the consensus mechanism. It's not trustful on its own, right? There's a lot of parameters that have to be defined, the legal and regulatory framework. So think of how do you attract people to an ecosystem? You have to answer all these questions to reduce the risk of participants acting in it, if that helps.
A brief follow-up. Could you comment on the possibility that we do have this one very secure blockchain, the original Bitcoin blockchain, and then connected to it via side chains, potentially you get all of this functionality of the private blockchain, but retain the security. So could the panel comment on what they think about like tech side chains?
Sure. So for those of you who want to look it up, there's a paper written about 15 months ago from a company called Blockstream, and it's talking about this concept of sidechains, basically pegging, cryptographically pegging a unit of account between 2 different ledgers. One would be the Bitcoin blockchain and one would be something else. I'm actually very skeptical of it for the same reason I'm skeptical of any kind of pegged ratios with any kind of currency. We've already seen what happened to the British pound in the early 90s. We've seen it happen again with the current Chinese RMB. So I think trying to reproduce a pegged currency solely because it exists today with other chains, I think is not. No one's done a whole lot of research on it, number one, which would be great for you guys to try and do. But number two, I just don't see the advantage of trying to mix those two together right now. I haven't seen a pretty good cohesive argument on that yet.
I'd actually never thought of side chains in terms of pegged currencies in the comparison. It's an interesting one to think about it. I mean, it's generally thought of as a mechanism to leverage that public blockchain and the trustlessness of it, the security of it, without having to go through the rather laborious governance problems you face with Bitcoin. So you can actually innovate and create these very different types of technologies inside a sidechain, and then basically fall back on the mining power that is Bitcoin to legitimate everything that's doing on that thing. The problem is that sidechains haven't yet been able to reach that perfect level because they'll need a protocol change within Bitcoin, which is going to be a very difficult fight in its own right. And what they're coming up with instead are models that would require, again, some sort of escrow setup where there are sort of trusted parties who will enter into a smart contract that sort of says this is what it is, and that may be creating the kind of problem that Tim was talking about, because if those 7 institutions are like, you know, the Bank of England trying to defend the pound, then you face a problem. But I think that it's not a perfect analogy to, you know, pegged currencies like that, or the Argentine peso or something, because again, there's this automated component to it. You're not necessarily talking about reserves backing it. It's a very kind of it's software that can't necessarily be broken, and so sidechains I think is promising. I think there's definitely a strong idea there, because it does get around the problem of Bitcoin's governance and the inflexibility of that particular model, and yet draws upon this broader base.
And maybe what I would just add to that is, I would think of interoperability of blockchains, right? So in NASDAQ's venture link, which is offering these private market securities, how are you going to pay for that, right? So chain lists on it. How are they going to, if I'm a buyer of their equity, how am I going to pay for that? Am I going to send a wire, do you know? Or am I going to use Bitcoin? If so, how do I make that very seamless in terms of the experience with 2 different sort of blockchain environments? So I think I could see interoperability for paying for digital assets with a digital currency that is used and accepted, right? Whether that's Bitcoin or something else. So intersections that way, perhaps.
Yes.
This is a question about the current legal structure that we have for governing indirect ownership, and how this new technology could be reconciled or is consistent with our current system, where, for example, in the equity market, what people trade are security entitlements against their brokers. They never own the security. And we're contemplating a technology which uses blockchain for maintaining ownership and registry. It's a fundamentally different world than we have now, where in the current world there's no mapping between trading and shares. It's just entitlements against a fungible mass of securities.
Man, this is a great question.
You love this topic.
Yeah, this must so I just literally wrote a paper just talking about this a little bit. So there's a law professor at Cordoza named Jeanne Schroeder, I believe her name, and her paper came out in August. So if you're looking like the legal perspective of how do you handle dematerialized assets that haven't been perfected, these securities that haven't been perfected through the UCC 8 or UCC 9. And the long story short is you actually end up having to give up a lot of the utility that comes. Like if you're using a permissionless public blockchain, you're going to end up giving some of that utility away, because you have to basically dox yourself. You have to identify yourself because of the way that the securities process works today. To become to go through a securities intermediary, you have to provide effectively identity of yourself, which defeats the purpose. I would argue it defeats the purpose of using a public blockchain. Obviously, Michael and I will have lots of discussions on this. But the question about how, if we dematerialize the rest, we have these book entry assets for scope of all these derivatives and so forth. How do we handle those on some kind of ledger? That still hasn't been full. There's no jurisprudence on this. It's a great question. Ask me again in 6 months, and hopefully there'll be some more law review articles. If you're a lawyer in here, please write a law review article. I'd love to be able to cite you.
Well, I just on that identity, regardless of whether or not it's doable on a public blockchain or you require some sort of federated or private blockchain, the identity question is key to it, right? Because you know, once we're talking about what is effectively, I think, you know, a bearer instrument, where this you know, you're actually literally trading your title to this share. The identity of that owner is a critical question, and that becomes an integral part of whatever model is developed, I would say.
Yeah.
So I asked this question as a practitioner, and it goes on nicely with what we just discussed, and that's how do you protect the privacy of the transactor and to give academics the ability to actually study the trading activity of institutions at the same time when you obfuscate digital identity without destroying it?
Man, that's a great question. So if you could give me a good, solid answer, you can make $1 billion. The question was how can you build a system that is private for the actual people transacting, these financial institutions, but it's transparent enough to where researchers such as you guys are able to go through and see patterns and create actual research based off of actual data. So the short answer is nobody's actually come up with a surefire way of making 100% privacy or confidential these transactions on any kind of ledger. There's a project called Enigma, there's another called Hawk, there's Zero Knowledge Proofs. There's probably like 6 or 7 I could rattle off. But the long story short is, as of today, as of the way the technology is you're not probably, if we had to go live, if these multi-consortiums had to go live, nobody would probably be trading because it's too transparent. There's not enough confidentiality within the transaction process. So, with that said, if nobody's trading, then you can't do any research. So we have to come up with a solution to this, and unfortunately, there doesn't seem like there's a silver bullet, as I mentioned in the slide.
And I can throw a little bit about Enigma, which is the model that I know the most about, and it's actually being developed out of MIT's Media Lab, and it is an attempt to try to have this cake and eat it too. So it's built around, I'm not a cryptographer and I can't give you the ins and outs of the details, but the way to think about it is this concept of secret sharing. And so this model where, to figure out what the absolute value of a pool of data is, you can build that from everybody sharing that information in a way that basically works like this. You start with a random number, say 10. If you're trying to figure out what the total salary, for example, of a group of people is, you say, start with a number of 10, and you go around the room and everybody adds their amount to that. And so what you end up with is 10, and the next person's 15. So we know now the number is 25. And there's at no point does the person who started at 10 divulge that. So you find out, you get around the whole lot and you come back to the guy who's got to 10, he's got the total, he can to divide that number by the number of participants and then figure out, what the absolute value is. And removing that, sorry, that's not quite right. He adds up the total amount, removes the 10. So you can get a total value of the amount of transactions on the system without having to know everybody's piece of it. And that's a very, very simplistic interpretation of it. But ultimately with that, there's this notion that we can start building rather sophisticated versions that start to obscure the independent information but still give you a very powerful data set upon which to do the computations that are necessary. So if you like, I can get you in touch with the developers of that program, and it's we think has great potential to grapple with this problem.
Yeah.
Go ahead.
Well, I was just going to say again, I think this is why you have different types of blockchains, right? Where the information and the values are so large and it's more aggregated participants, it might be tough to have this secret sharing, et cetera, concept. But on other things, it can be a lot more public in that value. So it gets back to the design of the blockchain. Where is the information very, very confidential? Where in aggregate, it's tough to, you don't want to divulge it, right? And that's maybe not your best case for a public blockchain, for example, in my humble opinion. And you want a more private blockchain where maybe the participants have all access to the gross data in that instance, for example.
Okay. Yes.
Curious, is there anything going on into how the mortgage meltdown in 2008 and the massive servicing and asset-backed securities RMBS where the borrowers were trying to put modifications, the lenders couldn't find paperwork, people were not able to get the modifications they want, investors were not happy with their own situation in their RMBS, whether blockchain is being thought of to address some of those problems, and whether there's being a look being taken to how that compares to MERS work that was done in the 90s, other lessons to be learned from both of those efforts.
I could jump in real quick if you want. So the idea of providence and how to deal with titles that have been changed, and who deals with that during some kind of disagreements, like the MBSs. You hear the sad stories of people who got foreclosed on because the paperwork got shuffled because the banks got acquired by another bank that got acquired by another bank, that kind of thing. So there's a number of startups that have basically pitched a solution to that, including Factum, Tyrion, Skew Chain. I mean, if we just look at it broadly from just a provenance perspective of cryptographically signing something, an asset of some kind, and seeing how that's modified down the chain of just ownership. There's a number of different companies pitching that. Again, I don't know of anyone that's done it in production. I know this is something that's probably near and dear to your heart, Michael, because you've looked at the various developing countries.
Yeah, it is. It's a big one when it comes to the question of asset registries. It's definitely a field of inquiry. I would say to a large extent it's what NASDAQ is grappling with private markets. I mean, one of the examples when NASDAQ talk about why they're doing this is the problem that Twitter still to this day, however many, 4 years since its IPO, have still got a team of like 5 people trying to dig up all the share certificates and reconcile them with who the new public owners. It was such a mess that it's one of the arguments I would say why a lot of these unicorns haven't gone public is because they're realizing that in this new era of private markets, going public becomes really, really difficult. So the provenance of title is a sort of a technical challenge, and yes, a lot of people think that the blockchain could be quite a powerful tool for dealing with that. I would say one other thing as well, and that is if you talk to Blythe Masters, who is, as many of you would know, one of the pioneers behind credit default swaps, and one of the reasons why she set up her blockchain company aimed at using the blockchain for real-time settlement is that she looked back at all the criticism that she came under for supposedly, creating these weapons of financial mass destruction, and decided that the biggest problem really was the transparency of where, the multiple synthetic CDOs and CDSs and so forth that had built upon just a range of different contracts and how you would keep track of that, and felt that there had to be some sort of solution to all of that. And so that does speak to the RMBS problems, all of the problems that emerged before the crisis. I think that there's certainly a lot of attention going on how this might be a solution.
And I was just thinking of Blythe Masters as well. I mean, she developed a syndicated loan capability, right, where settlement time is 27 days. There's multiple actors, multiple stages, nobody knows where it is, et cetera. So that's a specific example of she worked with JP Morgan to develop a syndicated loan blockchain capability to address some of that transparency challenge as well as speed of settlement time.
Okay, thank you all very much. I'm afraid we've run out of time. I would encourage those of you with more questions to come forward at the end of the session, but please join me now in thanking our 3 guests. Okay. Thank you all for coming, and enjoy the rest of the program today.